Hello, and welcome to the Presidio Group's Drive-In Live series. I'm Jason Stein, Managing Director at Presidio. I'm joined today by Kevin Tynan, Presidio's Director of Research. Hi, Kevin.
Hello, Jason.
We're thrilled to spend the next 30 minutes with an audience filled with senior leaders, decision makers, and executives from across the automotive space. In this Drive-In Live series, we're excited to provide a unique perspective on the earliest release of dealership data in the auto industry, which is provided through Presidio's exclusive partnership with NCM Associates and is representative of over 4,000 dealers across the United States. This partnership enables us to provide you with the most robust data sourced from the most rooftops in the timeliest manner available in the market. This is a unique forum where we go beyond the headlines and into the hard data. No one has a better or broader view of U.S. dealership performance. In this episode, we'll break down the latest benchmark report, give our perspective on the state of the market, and look ahead at what's shaping the second half of the year, including the evolving impact of tariffs, vehicle affordability, and brand segment profitability. Now, we're going to spend the first 15 minutes reviewing data and market trends, and then we're going to move on to your questions in the final 15. You, of course, can submit questions at any time by clicking the Engage button at the top right on your screen. One item, you can access our full report from our website, thepresidiogroup.com. And as a reminder, if you want to access this session on demand or have the ability to share this with your team, please set up your username and password on Presidio's LeaderPass channel. Okay, we have the quick logistics out of the way. Kevin, let's get to it. Let's start with the just released Q2 data. Average dealership performance data for 2025 second quarter showed all brand segments enjoying double-digit income gains after years of decline from pandemic-era peaks. And of course, the big headline, Kevin, a 27.1% year-over-year jump in net pre-tax profit for the average franchise dealership compared with the year earlier quarter. So what do you make of all this data?
Yeah, and look, the segment data, important. Let's temper that 27% with two things. 1 year ago, we had the CDK disruption, right? So there's some business that probably didn't get done in June, July of last year, so that comp is a little bit easy. And the other thing is there was no tariff impact last year, that there is a little bit that bled into the beginning of the second quarter this year. But fundamentally, structurally, what I see and what jumps out is that revenue diversity, that the franchise dealer base has been effective, and we've been talking about this for a couple quarters, of cycling away from dependence on the new vehicle market and then generating gross or even operating profit in some of those other business units, used, F&I, parts and service.
Let's drill down on fixed as a profit driver, because that really stood out here. The average dealership's fixed operations gross profit for the second quarter rose 6.2% year over year. Parts and service department significantly, obviously disrupted, as you said, by the CDK outage in June of 24. So what are you seeing out of fixed as that profit driver? Where are the opportunities?
Yeah, and look, I think that's going to continue to, and you got to remember too, when you think about new or used, you're talking at most, 5 to 10% cents per dollar going to gross, where in the parts and service, you're talking about 50 to 60 in some cases, right? So the bang for the buck there is huge, and I would expect that dealers will continue to lean on that. The other thing is we're seeing vehicle miles traveled be above 2019 levels, before pandemic, before we were isolated and shut down. So we're moving about, we're back in the offices, we're commuting, we're shopping, we're congregating. So that's just wear and tear on vehicles. That's repair and maintenance dollars. So that 6% is on a very large base, and it's a very optimistic sign that that's growing.
Really interesting. For the first time since pandemic high profits began to fall off in 2022, all three brand segments, luxury, import, and domestic, saw a rebound in year-over-year average pre-tax profit, putting them in the profit growth mode again. That domestic segment was the last to turn the corner in the just completed second quarter. So what are you seeing related to brand segments?
Yeah, that was the last, and we talk about this a lot, where supply versus demand really is what drives firm pricing, margin integrity, and that group, the domestic group, Ford, GM, the Stellantis, the CDJR brands, were the last to really get inventory in line. And I think they finally have and figured it out a little bit. You also have issues with with EVs. I'm sure we'll get to at some point, but they were really the last to get there where supply and demand were well in balance. And I think the franchise base across the board, cost structure is rationalized that now that there's that balance, the operating leverage of selling a few more vehicles is way better than it was just several quarters ago.
Used. The used business saw improvement. The average gross profit per used vehicle rising 10.7% to $1,567 on a year-over-year basis. Similar gain on a sequential quarter-over-quarter basis. Can you explain what's going on in the used market? And you have written in our report that used vehicles could mirror the trends of the new vehicle segment circa 2022 with fewer transactions, but firm prices and really historically wide margins.
Yeah, and that's the segment that really jumped out at me in this second quarter report was that, when we've talked about it, right? The used market will basically lag the new market. And we've been in this lower volume situation in the new vehicle market, higher pricing, firmer margins there. And that's where we have finally gotten to on used. My concern is that an undersupplied market like that makes it difficult for the franchise base for two reasons. One, you're competing for inventory with not only the CarMax and Carvanas of the world who only do pre-owned vehicles, but that increase in pricing on the used side also makes every private seller's vehicle worth more, right? So now it's like, well, I'll bring that to market myself rather than trade it in for a little bit less than what book is. So the fact that used market is as strong as it is, it just shows that the franchise dealer base is able to actually find the right vehicles. There's an advantage with being franchised, right? Because now you can do the CPO'd vehicles, factory warranty, you have the financing and the backing for those units. So that's really the one that jumps out as an opportunity, but the riskiest one, right? There was really the chance that margins compress there because you're competing with these other big used vehicle sellers. So very impressive that the franchise base is actually able to grow gross in that segment.
Dealer expenses have been a major topic this year, and we saw floor plan interest drop significantly. The average store's net floor plan interest expense continued its year-over-year improvement in the second quarter, helped by lower interest rates than a year ago. It moved from an expensive $36,360 in the 2024 period to an expense of $13,164 in the just completed quarter. Is that enough to offset rising operating costs?
Well, as you would say, it's better than a sharp stick in the eye. I'm not sure that how much control the franchise base has over that, right? You're going to do your deals. The interest rate environment is a little bit out of their hands, so you kind of go with the flow. When it's in your favor, it's great. I would think that, just what we see macroeconomically, the trend is to try and keep interest rates low for the consumer. So I think the anomaly was the high interest rate period. We are still high historically speaking, but I think the pressure will be to lower those. So that will continue to be accretive to earnings. Maybe it's still a cost, but it won't be to the level that it was several quarters ago.
All right, let's shift now to the mid-year Presidio Dealer Direction Survey. What does it tell you about dealers' outlook on the buy-sell market, first of all, and then how about profitability?
Yeah, look, I think that's all positive in the sense that revenue flexibility, where you can generate gross and operating profit, it just speaks to the ability of the base to be nimble, to adjust to what the market is. And it's one of those things where when you think about it, it's never a bad time, right? Either you're getting good value or you're getting at a peak of earnings, with good catalysts going forward. And I think we're in that, right? We're in this period where the dealers have done the work, rationalized costs, there's operating leverage now, and now you're just playing that out until the next whatever shock it is. The tariffs still have to play out to a certain extent, but there's a lot of uncertainty taken out of the market post-election and as we get through the tariff situation.
All right, you mentioned tariffs. Let's talk tariffs. Where are we in your tariff pandemic theory?
Yeah, look, and it wasn't as pandemic as it could have been, right? This was not 25% across the board for years. And I think we're getting through the worst of it. I think as we get in the second half of the year, less of an impact, but still an impact. And it depends on brands, where you're building. And to that point, I look at the capacity utilization number of automotive factories in the US. 80% is my target, and we've been under that for 30 some odd quarters, 31, 32. And I just looked at the second quarter number, and it was 68, 69%. It had been 65. So by argument, you could say that the threat of tariffs has brought a little bit more automotive manufacturing into the US, whether that's the brands, and it probably is the brands that have capacity here being able to produce more so than new capacity getting online and ramping and output.
Not that quickly.
Not that quickly, right? But the fact of the matter is that the number is moving in the right direction towards better utilization, which absorbs costs for the automakers, which is good for the industry overall.
You mentioned it earlier. Let's talk EVs. A lot of regulatory changes the past month or two. What are you seeing in the space, and what's the expected effect when, effectively, in the fall, every EV is going to be $7,500 more expensive?
Yeah, and look, this is going to be very different. This is going to be the first time we're ever going to see what that EV market looks like,
right,
without that kind of support ever. Right, so that 7,500, even when it was 200,000 units and you phased it out, this is going to be gone. So I think what you'll get third quarter especially is you'll see EV volume, and maybe the headline numbers are huge adoption numbers or sales volume of EVs. I don't think the profitability will be there. I think it will be more of an inventory management situation. Pricing could be terrible. Incentives, discounting could be very high, but it's about getting in position to be in position for the end of the year when those incentives and subsidies are gone. You, as a franchise dealer, as an automaker, want to have that inventory under control by the time that all happens.
And that's going to come back to something that we talk about all the time, which is brand and geography, right? Won't the brand and geography really relate back to who's interested in an EV and where?
And look, and I think the manufacturers can get back to what they do, whatever their brand strategy is, whether it's pickups and SUVs for the domestics. You don't have this financial and regulatory overhang of doing something that may not be profitable, or that you're not that good at, or that you haven't built scale at. So I think we'll see a little bit more of an organic market in the second half of the year and into 2026 and beyond, where it's, hey, we're going with what we do, what we're good at, and if that isn't right for the market, then we'll adjust. But it's not government or these subsidies that are driving the market to something that you don't really want to be doing or you don't do well.
What could the coming months look like for dealers who are watching this?
Well, look, I think you get to that organic market. I think still this is not a 17 million unit market. Look, we saw a seasonally adjusted rate of 17 in March and April, 17.8 and then a 17.3. We're not that. I also don't think we're a 15 that we saw in June. I think we're somewhere in the middle of that, 15.5 to 16. Yeah, I think that's a good number.
Yeah.
And I think that as you get to some transparency on the EV market, we can settle into that pace. Fewer units, but profitability good. We're not running away with a ton of inventory. 3 million, good number. For 1 to 1.5 million units, 60 days supply. We're right in the sweet spot, and I think it can be a little bit of business as usual in the second half of the year. Which is rare.
Yeah, well, business as usual would be unbusiness-like or unusual. What's the biggest risk you see in the second half of this year that might not be reflected in the Q2 numbers?
Yeah, the thing is not a ton of catalysts, whether macroeconomically or industry, that would say, well, here comes big volume, here comes super strong pricing or margin. I think the threat is that it's normal, right? If there is such a thing in this industry. But I think the manufacturers and the dealers are in a place where supply and demand are in balance. You can go about business. There's uncertainty around tariffs, of course, uncertainty around EV. And with that capacity that manufacturers have built, what do we do with that? So that's going to be a little bit costly. But for the most part, it's almost a lack of risk that is a little bit risky, that there's no real upside catalyst. I would say that the downside risk is eliminated as well to an extent. Could the new vehicle market collapse? Potentially, but again, we're not seeing the inventory that would lead you to believe that prices are going to fall out the bottom.
What about affordability? We've talked a lot about that too. How is affordability affected going forward?
Well, affordability is one of those things that depends where you're sitting.
Right.
Right? As a manufacturer, as a dealer, the lack of affordability arguably is a good thing because that's all our profitable stuff. We're playing our best players. And so the idea of moving down market and creating affordability certainly helps the consumer, and it might drive the headline volume number. But in terms of business economics, it's not a great part of the industry. The entry and move up segments, and honestly, it's why manufacturers have gotten away from it for the past decade plus. So affordability will mute total volume. That's why we're not going to be a 17 million unit market. But if it's a 15.5 and a 16 of $48,000 to $50,000 vehicles at 10% operating margin, if not more, it's a good place to be.
And with all three brand segments now experiencing rebounding profitability, it could be a year, just to go back to what you just said, that establishes maybe the average dealership's new post-pandemic normal.
Right. If there is such a thing, yeah. And again, we're not going to get to 2022 peak profitability, but I also don't think we're pre-COVID 2019 and earlier levels of profitability either. So, and I don't love the word normalization in this industry. I don't feel like anything's ever normal, but where it organically settles, I think is going to be a pretty good place somewhere in between the two, as long as we don't get inventory run away, which doesn't seem like it is, and pricing holds up. And again, I don't think the consumer can run and hide. I think there's enough at a 15, 16 million unit market, there's perpetually enough pent up demand to keep us there, right? We're not pulling forward like we did in March and April, where you're approaching 18 million. While that looks great on paper, it's not healthy for the industry to be there.
Yeah, excellent. So we're going to ask you to share your feedback and ask questions today. So please click the top right Engage button in order to be part of this broadcast, and we'll get to some questions. Our first question: in the second quarter, new vehicle gross profit per unit stopped a long decline from its pandemic peak and increased. So Kevin, how much were tariffs a factor in that, and what are the prospects for new vehicle PVR to continue to stabilize or really grow going forward?
Yeah, and I talked about it earlier with the disruption in the year ago quarter, tariffs versus not tariffs. And the thing, first of all, I wouldn't look at one quarter as a trend quite yet. The other thing is, when you think about the second quarter, very different tale between, say, April and June. And in April, you had that 17.3 million SAR with the threat of tariffs. And a lot of the European brands, which don't have a lot of production capacity in the US, I think you had a real rush to buy some of the more expensive vehicles, higher margin vehicles, pulled forward into April. And probably that momentum drove gross for the entire industry through the rest of the quarter. So, better than it being a decline, too early to call it a trend going forward. Because again, I'm not sure we see the catalyst for that, but it was probably that April result that really carried through the rest of the month.
But related to tariffs, I mean, there's some pretty big decisions here coming in the next month or so. And some automakers have said, okay, well, we'll absorb this for the rest of the year. How does that work as you start to get into the fall and maybe into the next model year?
Right, yeah, and we saw that with General Motors earnings, which, essentially they're absorbing those costs right now, Stellantis also, and I think that across the board. And that's a manufacturer with a lot of domestic production. So when you think about some of those import brands, those are going to be big costs that are being absorbed right now. I would say that you could expect that that's already accounted for through the rest of 2025. I just don't think you can take that kind of earnings hit consistently into 26 and beyond. But also, you're rationalizing costs in other areas to offset that. You're going to push some price increases down through the franchise base and to the consumer. So by 26, it certainly won't be the same impact that we're seeing now, but it won't be all absorbed by the manufacturers in the next by 3 quarters from now.
And depending on the manufacturer, which of course affects dealers,
Mm.
you wonder what happens to product going forward too.
Yeah, and
Decisions.
yeah, and that's a really interesting thing, and we've started to talk about this internally a little bit, where the really what ended was the mix shift to truck from car, and I was talking about this all summer, which was we're kind of at the end of the runway. We're 83% truck now, and I think the idea from the manufacturers was going to be the next earnings and price driver would be electric vehicles. And we're kind of seeing the bottom fall out of that. So if all that product and design and engineering and marketing went into that technology for the 26 and beyond model years, and now it's not there anymore, right? You don't have the same demand levers and the profitability levers that you were expecting, and we kind of reset to the end of trucks. There is no immediate way forward there. So product may be a little bit of, there may be some barren landscapes on product for the next couple of model years.
You talked briefly about the latest dealer survey. What did it tell you about how dealers are viewing brands and their future profitability?
Yeah, and I think there's a little bit of a tariff implication there, obviously with the import brands based on where your manufacturing is done. The good brands are still the good brands. I think what we would probably be watching is some of the brands that have been knocked back a little bit, and maybe it's the CDJR brands or a Nissan starting to cycle back around slowly and be a little bit more of an opportunity for the franchise base. It may be a little bit early even for them just yet, but I feel like as uncertainty comes out of the market and there's some visibility going forward, that you can see a recovery. And I think that's where the opportunity is going to be more so. Your good brands are always going to be your good brands, hopefully.
Right.
And I think there's opportunity in a stable pricing environment, good margin visibility, that some of those other brands start to come back around.
We're also seeing, the optimism persists, right?
Yeah.
The dealer community. And I think as some of that chaos is resolved or at least settles in, it's probably going to change the direction of the second half. Wouldn't you agree?
Yeah, and I think also one thing that we've seen, and this goes back, is that this isn't a race to the bottom market anymore for market share, where you saw it was just about overproduction, too much inventory, discounting, incentives, and it was basically who could give away more. I think the manufacturers across the board have seen what that supply-demand balance did during the pandemic period and have kind of been a little bit more disciplined on production, and you're seeing the impact of that. So it's not this, hey, I need X number market share, even if it's terrible sales and it's bad volume and they're bad buyers because they're really buying the deal and not my product. And I feel like it's a good thing that the industry's gotten away from that, and it's about keeping supply and demand in balance, firm pricing, residual values, and then it's about brand equity a little bit more.
Remember that you can engage with us with that button just in the top right there to ask a question. Another question here, how do you expect the recent changes in EV policy and the coming end of EV tax credits to specifically affect dealers? Part two, what will it mean in the long term, both for dealership operations and profitability generally?
Yeah, and I think you can see this big rush in the third quarter. Again, I would expect that inventory has to come in line, both from the manufacturer and from the retailers. So there'll be a scramble. The headline numbers of EV penetration might be really good in the third quarter, but that's really just being in position to see those price increases by the fourth quarter. I think a lot of dealers, manufacturers expecting this to be cut off at the end of the year. So this pulled forward to the end of September. If that's the way it plays out, is 3 months of inventory that you get cut off, that you have to be in line before the end of the year. So I would see a rush in volume, not great profitability, not great pricing. And then as we get to 2026, it'll be a little bit more of an organic market. If the demand is there, the buyers that want will get, but it won't be subsidized to the extent it had been.
We're going to see, as you said earlier, where the real growth is. Another question here, how much pent-up demand do you think is still really in the market?
Yeah, I think that at a 15 to 16 million unit pace, we're good. In the terms of average vehicle age, about 13 years now. The one thing, but going back to the answer to that earlier question, look, if we're in this little bit of a technology slowdown in terms of drivetrain tech not going electric, you could see that lengthen. So 13 years could extend as people hold on to vehicles longer if they're just not seeing the value. So, I feel like it's better than a 17 million unit market, right? Where you're not only is there no pent up demand, you're pulling it forward consistently and there's some payback or some hangover. But at 15 to 16, if that's where we settle, and would we say June was a 15.3,
Right.
a little bit better than that, I think we still keep that pent up demand in the market.
Are there consumers still holding on to their aging vehicles, thinking that it'll go back to pre-pandemic pricing and maybe levels of negotiating?
Well, I hope not, because that's not coming back, right? Those affordable vehicles just don't exist anymore. Every automaker, because of their cost structure, because of their capacity, their cost structure just warrants to build more vehicles, and you build more expensive ones, higher margin ones to do that. So any consumers or dealerships expecting that their brands will reverse course and come back to the affordable part of the market. And that's not to say that it can't be done. It just can't be done profitably. And if it's not going to be profitable, it's really not sustainable. You can use those products as entry and move up for those buyers to introduce them to your brand. But the question is, what's your wherewithal to do that? And if you do get somebody in at $25,000, but you're not profitable to 50, you're selling several unprofitable vehicles before you get there. So I would think that the Asia-based brands, the Toyota, Honda, Nissan, Hyundai, Kia would be the place to go for the affordable end of the market. The domestics and the Europeans aren't coming back to that.
Popular subject in many circles, Chinese manufacturers in the U.S. How do you view the possibility of Chinese manufacturers? And it feels inevitable, our questioner says or asks, but when?
Yeah, and this is I'm still working through a lot of this. This is a conference in itself. But
another drive-in live series.
But I think done correctly, and really to mirror the way that the Chinese manufacturers dealt with import brands coming in, if we were to go where you JV with a domestic partner, where they own the majority of the partnership, if you build factories here, if your profits are reinvested here, you're employing local labor, I guess it can happen and it makes sense, and you share your intellectual property going forward. I think there will be an administration, if it's not this one, that says, look what I did. I brought more dealerships, right? If they're going to sell through a franchise model, which would be another implication of the deal. I brought labor, right? I brought jobs. I brought profits and investment into our domestic manufacturing footprint. I don't know how it wouldn't be an administration that would say, look what I did, this is all positive for us as a manufacturing base.
We've talked on the podcast before with Michael Dunn, who has mentioned that the Chinese manufacturers are in every other market except Canada and the United States, and that there is some inevitability to it. And the bottom line, too, is that the products are relatively fantastic now.
Yeah.
So they're learning a lot in all of these other markets. Sales, leasing, fixed ops, right? Eventually, this has got to be the...
Well, and I think, the electrification question, the fact that we didn't go big double-digit EV penetration in this country quickly is actually to an advantage of our manufacturing base, in that we really can't compete technologically yet. So if this was an EV market and their product is better, we would actually lose that battle, and we could hand over the U.S. auto industry, and I'm talking, theoretically. So the fact that we pushed back, or the consumer, or the manufacturers, or the government, however that worked out, that we didn't go big EV adoption, to maybe be hyperbolic, might have saved the industry for a time. And now we can compete at our pace.
Yeah. A couple final questions. Is it sustainable to continue to see profit gains in all areas of the dealerships like we reported in the second quarter?
No, and I think the trade-off will be from the new market, right? And like I said, I feel like the pre-owned market was a surprise that was that good. I think that's still a difficult market because it's undersupplied, especially in 2025. We talked about lease penetration on low volume in 2022. 2022, which was the most profitable year for the dealerships, was 13.8 million new vehicles. Supply and demand imbalance, no incentives at all. In fact, we were over MSRP, which meant no leasing in 15, 16, 17%. So it's 2.5 million off-lease vehicles in a market that was used to 5 million every year. So 2025 is the worst year for the off-lease market, at least, which is going to drive prices of every used vehicle higher. So that was a little bit surprising, but I think the trade-off is mostly the new market gives up some of the gains, and then the other businesses make up for that. So no, not across the board.
Final minute here, final question. When you look across the auto industry, what areas really hold the best prospects for investor returns right now?
Oh boy, the dealerships. Absolutely. I just did this math for the fun of it. And when you look at returns, and I took 3 periods, 2019 before the pandemic, the peak of manufacturer, automaker profit market cap in 2021 and where we are now. The OEMs are actually negative from the peak in 2021, and the dealerships are way, market cap has expanded considerably through everything because of that revenue diversity. And the other one that has done well in terms of the equity markets is the retail auto parts companies. But the OEMs have been a difficult investment over the longer term. You really have to time it almost perfectly. Dealerships, you haven't had to do that.
Yeah, dealerships, there it is. Excellent. Thanks so much, Kevin. All right. That's all the time we have today. Kevin, thanks as always for your sharp insights and your view of the road ahead, which is winding, but fast. Thanks to our partners at NCM Associates and to all of you for making time for this inaugural Drive-In Live broadcast. You can find more insights, podcasts, and quarterly reports at thepresidiogroup.com. And remember, today's session is available on demand via your LeaderPass one-click link. Thanks for being with us. We'll see you next time on Drive-In Live.